an action plan. That is, what do we actually have to do to put any liquidity or debt protection insurance in place? So let's first understand what is driving the influx of property into SMSFs. Well, there's two major tax drivers. Firstly, the capital appreciation in property held in the SMSF context or any superannuation context. Your tax rate is effectively 10%, because if you hold the asset for more than 1 year, the nominal 15% rate is reduced by a third to 10%. Of course, what we will do for SMSF clients, and this is a major advantage for SMSFs over retail funds, is you defer realization of your underlying assets to the time when everybody is in pension phase. And what that does, of course, is reduces the tax liability to zero, because under our rules, tax is paid on realization of the assets. So if you defer realization until everybody's in pension phase, no tax is payable. And this, I would argue, is one of the last frontiers of tax planning in Australia, and this is driving the growth of property holdings within an SMSF. Now, coupled with that, of course, is a relaxation of borrowing restrictions in the SMSF context. So SMSFs can now be geared in certain circumstances. So you've got the combined attraction of being able to negatively gear property, as well as to get tax advantages by deferring realization until pension phase. And the real estate industry has picked up on this, and our clients are under increasing pressure now from the real estate industry to acquire property within their SMSFs. And in fact, there is evidence to suggest that a lot of the growth in the property market is being driven by the SMSF sector. Now, clearly there's a liquidity risk if there is an unexpected benefit or payment on a member's death or disability. So you can also, in the context of debt, experience difficulty in servicing principal and interest on the debt if in fact there's premature death or disability of any of the members. Now, if we just think through the consequences of not addressing the liquidity risk, firstly, there's a delay in making benefit payments until the assets can be liquidated. Now, the reality is, if there is death in a family or disability in the family, there is an immediate demand for cash to fund the ongoing living expenses of the family. So unless you've got cash in the SMSF or access to cash some way, the family is going to be financially embarrassed, even if they do have the assets tied up in property. Now, the other issue that we've also got is that there's prejudice to the members' business interests if SMSF assets have to be realized. And by this I mean a number of business partners are now holding the business assets, the business real property, such as a factory, for example, in an SMSF, where the members of the SMSF are in fact the business partners. Now, if we don't address liquidity or debt protection in that particular structure, we're going to prejudice the ongoing viability of the business, because you don't want the asset of the business to be sold from under your feet. The third issue you've got, if you don't address liquidity issues, is that you're going to get low realization values, because the moment you sell under pressure, Murphy's Law operates, and in that situation, you're not going to get full value. It also destroys, premature sale of the asset also destroys your tax strategy, because remember, your tax strategy here is to defer realization until everybody's in pension phase. The moment you have to sell the asset under pressure, while the members are in the accumulation phase, you're crystallizing tax liabilities and picking up a tax liability as well. The next issue you've got is if you don't address liquidity and debt protection issues, you are in breach of the SIS regulations, because the SIS regulation dealing with the formulation of an investment strategy specifically obliges a trustee in formulating an investment strategy to consider, amongst other things, two very important issues. And those issues are, firstly, the liquidity of the fund, and secondly, the repayment and the service of any debt that the fund has assumed. So, having said all that, what solution can we put in place? And the life insurance solution here is a very simple and very elegant solution, and I add that there are a number of variations of the solution theme, and I'll deal with some of those permutations as we go along. So what we're going to do, and all the permutations achieve this, is we're going to produce, we're going to have life cover that is going to produce liquid funds in the SMSF that is going to enable us to pay out the death benefit or the disability benefit without having to realize the underlying asset. Now, the first point to note here is that conventional life cover in super, that's the life cover with which we are all familiar, does not address liquidity or debt issues. Because if you think this through, the premium is typically, in this situation, debited to the member concerned, and the claim proceeds are paid or allocated to the deceased member's account. So you're not addressing liquidity issues by way of conventional life cover in super. You need to structure the life cover slightly differently. Now, one solution that you've got is you put in place cover that is not for the benefit of the individual member in that sense, but that life insurance policy is effectively an investment of the fund. And what that means is that the proceeds are then shared amongst the members, and the exiting interest receives value, and the SMSF continues to hold illiquid assets for the remaining members. Now, if you are dealing with SMSFs in a business context, that is where the SMSF members are partners in a business, this type of arrangement needs to be bolted on to the buy-sell arrangement. The buy-sell arrangement will deal with the transfer of the equity in the business, and this arrangement will deal with the transfer of the deceased interest in the fixed property. Now, let's get down to a specific example, and this will hopefully clarify things a little bit in your minds. We've got Peter, Paul, and Mary who operate a business, and the business premises are held through their SMSF, and they've all got a 1/3 interest in the SMSF. So if we look at this SMSF, we've got factory premises, $2 million, cash of $100,000, and I've kept this simple. There's no liabilities at this stage. Now, what that means is each member has a $700,000 interest. Now, one solution we can put in place, we can say that the life insurance is an investment of the fund. And what we're going to do is that the life insurance is going to yield sufficient cash to fund the death benefit. But because it is an investment of the fund, we need more insurance than the net asset value of the fund. And the reason for that is, of course, the deceased interest is going to participate as well. So in this particular example, I've suggested cover for $900,000. Now, if we just work through this particular situation, let's say Peter dies, and the trustee is paid $900,000 by the life insurer, because this policy although it's an investment of the SMSF, is still owned by the trustee. So we've got a $900,000 cash injection into the SMSF. So the balance sheet now reads factory premises of $2 million, so that hasn't changed in value. We've now got cash of $1 million. So there's $100,000 we started off with, $900,000 from the claims proceeds, and that's $1 million. That $900,000 benefit is allocated to each or allocated amongst the members. So each member effectively gets $300,000, and that means what we've got at the moment is a boost in membership interest to $1 million. But we do have a cash now of $1 million sitting in the fund, and that cash is sufficient to pay out the deceased interest of $1 million. So Peter's nominated beneficiary gets paid out $1 million, and Paul and Mary remain as members of the SMSF, owning the factory premises. Obviously, going forward, this is a single asset SMSF, and Paul and Mary need to top up their cover to ensure that in the event of either Paul or Mary's death, there is sufficient liquidity in the fund. Now, there are variations of this particular theme, and one variation is what they call a cross-holding model. Now, under the cross-holding model, what we would do in the Peter, Paul, and Mary situation, and this is where the cross-holding model has advantages. The cross-holding model, we only need $700,000 worth of cover. Because what we will do is we will have a policy for $700,000 on the lives of each of these of the three members, except in this situation, the premiums on Peter's life will be paid by Paul and Mary and debited to Paul and Mary's interest. The premium on Paul's life will be paid by Peter and Mary, and the $700,000 on Mary's life will be paid by Peter and Paul. Now, the advantage with the cross-holding model is that you are able to avoid the grossing up of that $700,000 to $900,000. However, it does have disadvantages because in the cross-holding model, the premium, most people will take the view that the premium is deductible for tax purposes, whereas in the example that you've got on the slide, for the grossed up amount, the premium is deductible. So it's a question of horses for courses. Which solution, in my view, best suits client, either going the grossed up way or the cross-ownership way does, in essence, deliver the outcome that we want. The outcome that we want is a payout equal to the member's interest and avoiding realizing the asset. So what would happen in the cross-ownership model, Peter's $700,000 would be paid out, and Paul and Mary would continue as members holding the factory premises. Of course, by this particular action, they will get a boost in the net asset value of the fund because of exit. Now, what you can do is you can also couple those two solutions that we've got, whether it's a cross-ownership or the grossing up that I've outlined, with debt protection insurance. Now, what debt protection insurance does is that we put policies on the lives of the members to repay the limited recourse debt on the death or disability of the member. And in this case, the debt protection insurance works no differently from debt protection insurance outside super. What happens is the trustee receives the claim proceeds, and the claim proceeds are then used to repay the borrowings. Now, debt protection insurance does present a challenge, and the challenge it presents is that if in fact we repay some or portion of the debt on a member's debt, we are going to boost the net asset value of the fund, and therefore effectively the interests of the members, including the deceased member. And if you go down that track, you need to then determine as to whether or not who gets the benefit of that boosting in net asset value. If you want to have complete equity between the partners, that boost created by the repayment of the debt is going to substantially increase the amount that you require for liquidity insurance. Very often, the view you will take of debt in an SMSF is that in the event of death or disability, there should be a stream of rental income from the underlying property, which you're not going to realize, and that stream of rental income will be sufficient to fund principal and interest. In that situation, I would argue that you don't need debt protection insurance. You certainly need liquidity insurance, but you don't need debt protection insurance. Now, what we can do is we can also have a simplified approach where what we do is we just simply take out insurance, treat it as an investment of the fund, so there's no cross-ownership situation, and the agreement or the SMSF rules would simply provide that the exiting interest gets an amount equal to the insured amount or the member balance immediately prior to death, whichever is the greater. Now, the simplified approach has an advantage, and the advantage is that you need less cover. However, it does mean that there is a boost in net asset value which falls to those who are left behind, and the question is that an appropriate situation where a member dies? In the Peter, Paul and Mary example, that outcome, in my view, is not appropriate, and the reason for that is that all partners in the Peter, Paul and Mary context should receive the benefit of the boost in the asset value. Whereas if you just paid out Peter $700,000 in that example, which is the net asset value of the fund, Peter, Paul and Mary, the remaining members, effectively get a benefit at the expense of Peter. And that's not an appropriate outcome where the members are arm's length members. But in a closely held family situation, that may not be an issue. If it's a mum and dad superannuation fund, for example, you might say all in the family, and therefore the remaining members getting that free kick, as it were, should not be a problem. Okay, so if we look at these solutions that we've got for debt protection and liquidity insurance, let's consider now whether or not any problems are posed under the SIS provisions. Now, the first issue you've got to consider is the sole purpose test. And remember, the sole purpose test is there to stop the abuse of the tax-favoured status of superannuation funds by members engaging in activities which are not appropriate for a superannuation fund, such as business and trading activities. Now, the provision of liquidity and debt protection insurance is the provision of a death benefit or a disability benefit the member. That is the ultimate aim of our insurance in this situation, and the position, therefore, that TAL takes, and obviously this is an issue that the advisors of the client need to be comfortable about, is whether they agree with that approach, because provision of death or disability cover is clearly authorised by the sole purpose test. On the side is the investment strategy requirements contained in Regulation 4.09. 4.09 obliges you to consider liquidity in debt issues as a trustee, and I would argue by taking out this insurance, we are complying with Regulation 4.09. I hasten to add this is not the only way you can comply with these provisions of 4.09. For example, the trustee may form the view that there is sufficient stream of income into the fund to meet the death benefit in pension form, for example, and if the rules provide for the payment of the death benefit in pension form. You may not need this type of strategy in that situation. The third regulation we need to be aware of under this is Regulation 5.02. 5.02 says that the premium expense must be allocated on a fair and reasonable basis. If you treat the liquidity insurance as an investment of the fund, we argue that this cost is simply prorated amongst all members. So the cost is aggregated, shown as an expense in the P&L, and effectively all members then carry that cost pro rata to their membership interest. If you are dealing with a cross-ownership model, of course the cross-ownership model means that the costs are carried by the members other than the life insured. So for example, if we were doing a cross-ownership model in Peter, Paul and Mary situation, the insurance on Peter's life would be carried by Paul and Mary, and that cost would be debited to their respective membership accounts pro rata to their members' interest. Now if we simply take this to the P&L, the question arises, what about the age and health issues of members? Our view on that particular issue is that age and health is not relevant in this situation because everybody is going to benefit irrespective of age and health. So let's move on to the tax treatment of premiums. Now, the position we take on this, and again, it's very important for the clients to get their tax advisors to apply their minds to this issue, because it is fair to say that there is a certain amount of controversy around the tax treatment of liquidity and debt, or liquidity premiums in particular. Our position is that it's no different from any other life insurance in super. The moment you deal with life insurance in super, you've got to consider the provisions of Section 295 to 465. What that section effectively says is that you will only get a tax deduction if the premium is paid to secure a superannuation death benefit or a disability superannuation benefit as defined. Now, those definitions are linked to the conditions of release. So basically, you have to provide insurance in a super fund in order to get a tax deduction for that insurance to be covered by the conditions of release. It's not dependent, the deductibility doesn't depend on the actual mechanics of providing benefits, and therefore our position is that liquidity insurance securing debt is no different from any other premium. It's deductible, and similarly, if you're attaching a TPD rider to the policy, the same issue, the same principle would apply. Of course, if it's own occupation cover is not deductible in super, and therefore you will only get a deduction for the any occupation portion. If you are dealing with the cross-ownership model, the general consensus on the cross-ownership model is that there is no tax deduction because the trustee is not incurring that cost, it is effectively carried by the individual members through debits to their respective membership accounts. Now, the debt protection insurance premiums are treated differently, in my view, from liquidity insurance premiums. And the ATO has expressed a view that debt protection premiums are not deductible. And this view is contained in Example 9 of ruling TR 2012/6. This ruling deals with TPD insurance in super, but this particular example covers debt protection situation in super fund. And with respect, I think the ATO's view is correct, because in order to fund a deduction, in order to get a deduction, the premiums must fund superannuation death benefits or disability superannuation benefits for members. Now, in this situation, you are repaying the lender directly, because if you think of a flow of funds in a debt protection situation, the insurer will pay the money over to the trustee.
I think I have.
The trustee in turn will discharge the debt, in which case you're not providing a death benefit or a disability benefit to the member. And this treatment is consistent with debt protection insurance outside super. So there's no deduction for debt protection insurance. Just my view on deduction generally for liquidity or debt protection insurance, if you decide to play this conservatively, let's say on the liquidity insurance side, you say there's no tax deduction for it, my view is that that does not invalidate the strategy. You are still going to need liquidity insurance irrespective of deductibility. And of course, if you are going to lose a tax deduction, lose it in an entity that's taxed at 15 cents in the dollar, such as a superannuation fund. Now, having said that, let's consider now what happens on claim. Now, under all the models, the claim proceeds come into the fund, and the claim proceeds of any asset that is realized, and that's including insurance in a superannuation fund, the claim proceeds under the Tax Act are capital in nature, unless they fall within a specified exception. For example, fixed interest securities fall within one of those specified exceptions. Insurance is not covered by the exception, so you therefore default to the general rule, and that means the insurance is a capital asset in the fund. And then you apply the capital gains tax rules, and there's an exemption under Item 5 of Section 118(300). What Item 5 effectively does, it says that if a trustee of a regulated superannuation fund receives the proceeds of an insurance policy on death of a member, that is free of capital gains tax. Unfortunately, the position with TPD is a little murkier, but that's no different from any other TPD in super situation. The existing practice of the industry is to treat TPD claim proceeds as being exempt. So the claim proceeds flow through to the disabled member and are taxed in the member's hands. The technical basis for that approach is somewhat dodgy, but that's the way the industry does it. And the government actually has announced that it is going to introduce measures to exempt insurance proceeds in superannuation funds from capital gains tax. And the reason for that is, of course, the benefit is taxed or may be taxed in the hands of the recipient when it's distributed out of the fund. Now, once the money's in the fund, if you are dealing with a cross-ownership situation, the proceeds are being dealt with specifically in terms of the rules that you've established under the cross-ownership provisions in the deed, and that is the proceeds then get paid out to satisfy the interest of the deceased member, and the deceased member's interest is reduced to zero. If you're adopting the model that the policy is a fund investment, then you need to be mindful of Regulation 5.03. What 5.03 says is that you've got to prorate the benefit amongst the members, and you've got to set the exiting benefit at claim proceeds or member account balance pre-claim. Now, in that situation, in the Peter, Paul and Mary situation, what we did is we simply prorated the 900,000 coming in amongst the three members. Where one needs to be a bit careful here is the provisions of Section 292.25. And what 292.25 in essence does, it says that if you appropriate a reserve of a superannuation fund for the benefit of a member, that appropriation is a contribution. And not only is it a contribution, but it counts towards the member's concessional contribution caps. So the big issue here is, are we somehow appropriating a reserve? And it is very important for the client's tax advisors to consider the situation. Our view is that an appropriation of a reserve, because a realization of an investment and the allocation of the proceeds of realization of an investment are not an allocation of a reserve. The ATO has declined to express a definitive view on this particular point. What I do recommend, however, is that as far as the bookkeeping goes, debit cash, credit members' accounts, don't take it through a reserve because you don't want to invite debate as to the fact that your bookkeeping treatment has somehow triggered Section 292.25. Once the money's in the account and allocated to members, you then pay out the death benefit, the disability benefit in the usual way, and the normal tax rules will then apply. So if it's death, it's tax-free. If paid to a dependent, TPD, of course, is taxed on a formula basis. Now, under these models, and that occurs both under the cross-ownership model as well as model of treating the investment as, or treating the insurance policy as a fund investment, there's going to be a boost in the remaining member balances. Now, if you were to distribute that boost in the balance to the remaining members, that, of course, will be a taxable component of a lump sum superannuation benefit. But, of course, what we are going to do in regard to the surviving members is that we are going to defer payment in either lump sum form or pension form until they are aged over 60, in which case we'll get it tax-free. So you will manage that tax liability in that way. All right, having said all that, and we now want to implement a liquidity insurance plan or a debt protection insurance plan, what do we do? Well, step one is that we need to sit down with the balance sheet and do an asset and liability review. And that review will identify any liquidity and debt protection risks. That's your important first step. Once you've highlighted some risks, you've then got to consider the liquidation strategies. You might be able to deal with it without any form of life insurance, simply pay the benefits in pension form. If that's not an appropriate solution, you then move to the insurance solution, and you've then got to decide on the methodology you use for the premiums and claim proceeds. For example, do you want to go the cross-ownership way, or do you want to go the way of treating the policy as an investment with the associated grossing up consequence? Next thing you've got to do is you've got to review the trustee. You've got to make sure that the insurance in the format that you've proposed is permitted, and that it is possible to deal with the proceeds in the way that you want them to be dealt with under the rules of the SMSF trustee as they now stand. Then you obtain the requisite life insurance advice and formulate a proposal for consideration at the trustee meeting. You should also brief the auditor on the proposal. The auditor should be very supportive of this because you are assisting the trustee in complying with the SIS provisions. However, if the auditor does have any issues, it is best that you know about them before you implement the proposal so that you can address those issues. When you prepare your SOA, make sure that it is consistent with other documentation that is going to be prepared. And the other documentation will be the minutes of the trustee meeting. You then hold the trustee meeting and you minute that meeting, and TAL does have a template, and you're welcome to access that template and use it as the basis for determining an appropriate minute for your clients. You then obtain the requisite premium cover, and you then have to allocate the premium cost in accordance with the documentation. And that's very important that you brief the bookkeeper from a practical point of view. Because if you're going a cross-ownership model, you're going to have to debit member A's insurance premium to member B's account, or if you're going the ownership full investment model, you then will be putting the premiums as an expense on the P&L. Either way, it will be you'll be dealing with the premiums on a slightly different way to the way life insurance in super is normally handled, and you need to make sure that the bookkeeper is familiar with the outcomes that you want. It is very important to disclose any liquidity or debt protection insurance in the member statements. This is just purely a housekeeping thing. All you need is simply a line item on the annual member statement. Very important because values move and debt moves. This arrangement is reviewed annually and updated if necessary. I regard this as a positive and not as a negative. The reason why I say it's a positive, it is an ideal opportunity for you to engage SMSF trustees, members and their accountants on these particular issues, and it gives you an opportunity to talk about risk in general to those individuals. Morris, I'm now going to, that's all I've got to say. Morris, I'm now going to hand back to you, and we can then take some questions. Over to you.
Yeah. Can you hear me, David? Hello?
Yes, I'm still there. Okay.
So thank you. What I'd like to do is, before opening up to the audience, I'd like to maybe ask Romano or Laval to help provide some guidance on where we as a group feel we're at with some of this. But one of the other reasons for pulling this together is many of you planners, paraplanners, risk advisors have been exposed to some of the DBA sessions on this as well too. And it's talk purely about some cross-ownership trends, and which David has alluded to. I think what we'll try to do with David is to look at the full gamut of options available, their pros and cons there as well too. So Romano, Laval, is there anything that you'd like to add to or question David on this?
You can go first, Laval.
I don't have anything, Romano.
Yeah, basically all I just want to make sure, and this is the reason why we asked Morris to do this, is that the DBA view is not the only view, and in some situations it is appropriate to do cross-ownership. In other situations it won't be, and you need to be aware of all the facts and the issues. And like we always try to do, and this is one of the things we'll do with the Stilling, Stilling Day session, is provide the different alternatives that are out there, and that way you're able to answer the different questions that advisors, that clients may have in that regard. So it's an information brief, and to make sure that we choose the right option for the client depending on their particular circumstances.
Absolutely. I can only endorse those views, Romano. I think that's the appropriate way forward.
The other question that I'd like to ask David, if that's okay, is David, you pulled this together and you're presenting to a lot of accountants, financial planners on this, so there's obviously a lot of activity on I suppose, putting in insurance inside SMSFs for these purposes. How big do you see this opportunity, or have you seen activity on this opportunity?
We've seen enormous activity in this space, Morris.
Yep.
Simply because the property market is driving this rather than our activities, and the negative side of that is somebody is going to get burnt at some stage on the liquidity and the debt protection side. And my concern for advisors and accountants in relation to this is that the clients then turn around and start pointing the finger of blame at the accountant or the insurance advisor, not for anything they've done, but for stuff they haven't done. I always say you get into trouble more for your sins of omission rather than your sins of commission.
Yep.
So it's very important, I think, from a business risk mitigation point of view, for us to actually alert our clients to these particular liquidity and debt protection risks, because clients are just diving in without actually thinking through the risks. Because everybody is seduced by the capital gains being tax-free at the end of the day. And tax strategies are very seductive in some ways because they cause people to lose focus on really considering other risks.
David, we've got a question here in Colac from Andrew.
Yeah, hi David. Just wondering, what are the penalties of not having adequate cover, and who bears those?
You are in breach of an operating standard. Firstly, because it's all covered by Regulation 4.09. Now, 4.09 is an operating standard. So the trustee is firstly, breaches of operating standards carry a penalty of effectively 100 penalty units, and the tariff is $170 at the moment per unit, so it's $17,000 penalty potentially payable. And probably more importantly, in my view, is that if you're in breach of the investment strategy provisions, you are also in breach of a covenant. And that means a member can then bring an action against a trustee for breach of covenant for any loss suffered by that member. So somebody, let's say, suffers a stroke and is disabled, that person can bring an action against the trustee because the trustee really has failed to consider the liquidity issues in the particular structure they've adopted. Now, people have said to me, oh, that's not really a risk because they're just suing themselves. But I don't think that view is correct, because typically what happens if somebody suffers a stroke, there's going to be a guardian or trustee who's going to look after that person's affairs. And that person is going to take action against fellow trustees. So the fellow trustees will be in the gun in that situation, in my view. So what we want is some sensible risk mitigation here.
Thanks, David. Any other questions from the audience? Got quite a few.
I've got one. Warren from up Brisbane.
Yes, Warren.
If David could just explain with the member statement how the insurance should be disclosed, because in this example we have the insurance of $900,000. The member was really only getting a $300,000 benefit from it.
I would just disclose it as a note in the statement. Simply saying there's a insurance policy of $900,000 held for liquidity purposes, and each member will share in the proceeds pro rata to their membership interest. That's if you're doing the full, if you're doing the grossing up. If you're doing the cross ownership, you would just put a note there saying the members have entered into a cross-holding arrangement in terms of which, in the event of a death or disability of a member, the amount of X dollars will be paid out to that member.
Okay, thanks.
Right. Any other questions? Okay. What's probably the message I would like to get across to everyone is I'll put this up on our cohort, the whole presentation with David's commentary on the cohort YouTube site. I'll send around the presentation there as well too. Obviously, there's a lot of activity in the industry, out there in the market, but also within our own group, with our SMSF business development team, our accountants, along these lines. And what I really want to do is make sure that we supply you with a lot of background technical information and those action plan slides of what you probably could look at if you are concentrating on this area. So there is an opportunity, but we've given you a lot of the pros and cons of what you might delve into as well too. So please take the time out to maybe watch this with your accountants and your SMSF teams, and then look at the action plan of how you can all benefit from this, or mutually benefit from this as well too. So, that's probably my final message. I'll send around the slides today, and then put the YouTube up in the next 2 days. Hopefully today's session was beneficial to all. So thank you very much, David Glenn from TAL. Really appreciate it.
Could you also circulate to everybody that DBA article on cross ownership, because that sets it out pretty succinctly? Yep,
absolutely. All right, thanks everyone for attending, and hope you got something out of it. And we'll talk to you all soon. Bye.
Bye.